Hi, this is Samer Halal, your trusted financial advisor from Cleveland, Ohio. A hot issue lately we've been hearing about is interest rates and mortgage rates. You know, we keep hearing how mortgage rates is hitting 10, 15-year highs lately. So let's talk about mortgage rates. A mortgage rate is the interest rates that you as the borrower tend to pay on your mortgage loan that you receive from your lender. Mortgage rates can be fixed for the entire duration of the mortgage. So you've heard of a 30-year fixed mortgage or 15-year fixed mortgage. The rates can also be variable based on a certain index, and typically they can only move within certain confines. Interest rates that are charged by lenders are determined sometimes by the amount or by the volume of mortgages that they have on the books. So for example, if a certain lender believes that they are light on mortgage loans, or they don't have enough on the books, they may lower their interest rates that they are charging on their mortgages just to increase the volume of the applications. And the opposite is also true. If they believe that they have too many loans on the books all of a sudden, they may automatically raise their interest rates for the time being, and that makes them less competitive and they would get less applications. So that is also a factor that determines what interest rate is. But there are four main factors that determine how much interest you're paying on your mortgage. Number one is typically what is called the cost of money. The cost of money is typically how much it costs the bank to borrow that money before they lend it to you. In mortgages, there tends to be a high correlation between mortgage rates and the 10-year treasury. So you can estimate what that mortgage rate is going to be based on following the trend of the 10-year treasuries. If those yields are going up, then typically your mortgage rate is going up, and the opposite is also true. The second factor in determining a mortgage rate is your credit worthiness as a borrower. And that encompasses several things: your income, your habits of paying your bills on time, how much debt you currently have, your debt to income ratio, a whole bunch of stuff that they look at, your credit score, obviously. So a whole bunch of factors that are encompassed under the category of your credit worthiness. Number three, that is the collateral, which is typically the house that you're buying. And what we mean by that is, looking at the collateral, how is it going to appraise? Is it going to appraise high? Is it in good shape? Does it require a lot of work? Is it in a good neighborhood? That all of those factors assess the risk that's associated with that specific house to the lender, just in case they end up having to take that collateral if you default on making your payments. And then the fourth factor is how much money or what percentage equity you're going to have on the onset, meaning how much money you're going to put down initially on the house. So if your equity is going to be 20%, that's the old 20-80 where you're borrowing 80% of the house and you're putting down 20, versus if you're putting 25 or 30, typically the more money you put in up front, the more equity you have in the house on the onset, the better the interest rate is, because that indicates less risk for the lender. I hope this helps. If you have any additional questions, use the data below to reach out and let's talk. Have a wonderful day.